Hi everyone, welcome to the Planet Tracker presentation as part of London Climate Action Week. My name is Catherine Tubb and the title of the talk I'm giving today is Beyond the Brands, Unpicking Investor Risk and Opportunity in the Textile Supply Chain. So as an introduction to myself, I joined Planet Tracker at the start of 2021 as the Senior Investment Analyst in the Textiles team. And in my career before joining Planet Tracker, I spent 10 years at the equity research house Sanford Bernstein, researching a range of industries, mostly focused on chemicals, although with experience in luxury goods as well. And then I spent 3 years at the think tank, WeThinkX, looking at the economic disruption of the cow. Before all of that, I completed a PhD in organic and computational chemistry at Cambridge University in the UK. And so a lot of my work in my career has really been focused on disaggregating supply chains and trying to make them more understandable to the investment community, and which is a huge focus of what we're trying to do at Planet Tracker, but of course with that added layer of environmental disclosure and impact. So just as an introduction for those of you not particularly familiar with Planet Tracker, we're a not-for-profit financial think tank launched in 2018, seeking to align investor capital with planetary limits. And at Planet Tracker, we really aim to build upon the growing recognition that the finance community is not yet accurately quantifying environmental risks and integrating environmental data into investment valuations and decision making. And this is partly caused by a distinct lack of transparency, effective disclosures, and awareness around company and market dependencies on natural resources, otherwise known as natural capital. And it's our belief that if we continue business as usual practices, the degradation, if not outright collapse, of many natural capital resources will actually happen within most financial professionals' lifetimes. At Planet Tracker, we're aiming to really address these issues, and we're focused on 3 programs: oceans, food and land use and materials, and the textiles team, which I work on, sits alongside plastics on the materials workflow. So the aim of the textiles program is really to enable investors to place value on natural capital and therefore price natural capital risk accordingly, and then ultimately for investors to be able to make decisions based on that risk. So we're very much trying to affect change through the financial markets, a much more top-down approach. And in simple terms, natural capital can be thought of as the assets that the earth provides, water, air, soil, that many industries rely on, just but perhaps don't adequately value. And for full transparency, our textiles work is funded by the H&M and Lauders Foundations. The work at the team has been relatively nascent. We're at the start of a 3-year programme, and our work has really ranged from in-depth tracker reports and briefing papers to blogs across all aspects of the textiles value and supply chain. And how we look at the textile supply chain is a key differentiator in our work to the rest of the financial industry, including investors. It is a far-reaching and in certain areas fairly opaque supply chain consisting of thousands of independent companies in a complex network coordinated by textile orders from the brands, owners or end retailers. In reality, it's a pretty linear chain, although of course there's plenty of moves to make it a much more circular-based economy. On this slide, I've shown one illustration of how we're at Planet Tracker are looking at it. Each circle here represents a node or a key part of the supply chain. It starts off with the raw materials, either natural fibres like cotton or wool, or synthetics, which are usually plastic-based, coming from oil or fossil fuels. And the most common natural fibre is, of course, cotton, while the most common synthetic fibre is polyester. In fact, 60% of all synthetic fibres are actually polyester-based. So immediately you can see the raw materials there rely on land and water used to grow the crop, so directly or to even feed animals to produce them, and they all come as a derivative of oil. And then these raw materials, using this natural capital, are turned into fibres, made into fabrics and dyed and finished, which is the wet processing part, before garments are assembled and retailed. Now, it's worth mentioning that these initial nodes are mostly done in emerging markets, with China being the largest manufacturer of textiles globally, with about a third of total production, but India, Vietnam, Bangladesh, and Turkey all also having thriving industries. So after retail products hit the consumer, and from here we identify a kind of post-consumer node and end-of-life area. The end of life really represents the destruction in terms of incineration or landfill, whereas post-consumer represents either the secondary market or reuse of the materials. Now, end of life also has a lot of focus and impacts on the environment. Often clothes end up back in the emerging markets where they were made to be disposed. In addition, we're seeing other natural capital-based issues such as microfiber shedding, which of course happens throughout the whole production of the whole system. So at Planet Tracker, we've done some initial mapping of this whole textile system, the whole textiles industry in financial terms. We believe investors are missing the environmental risks associated with natural capital because there's just this lack of understanding around the impacts across the whole supply chain. And the bulk of financial value in the fashion industry really is measured by market capitalization, concentrated in the downstream section of that supply chain, populated by large consumer brands and retailers. And of course, the investor intention is on the brands because that's where the revenues are. But we have bigger aims at Planet Tracker. We really want to thoroughly understand that whole global textiles industry from farm to frock to landfill, and who the investors are through the whole supply chain, which is a huge task. You know, our expectation is that financial capital is mainly focused on the retail part, which of course has proved to be true. But so far we've mapped over 10,000 listed companies with revenues of almost $3 trillion and a reported market cap of at least double that, likely much more. And this is in no way comprehensive yet. These are only the companies that we can find in financial databases like FactSet and Bloomberg, and that have revenues over $10 million. Now, many of these companies will be solely focused on the textile space, while others have it as a small part of their larger business. So far, the data we've collected is much more comprehensive in the center of the supply chain, but we're still doing a lot of discovery for the earliest, so the raw material aspects, and later parts, so the more kind of post-consumer use. Now, while this data is nascent, there is that clear conclusion. Most of the financial markets are focused on the retail or brand end, as that's where the sales are, although many of those retailers are, of course, fairly vertically integrated. And you can see this in this diagram. The retailers have the bulk of that $3 trillion of revenues of $2 trillion. And of course, it gets less as you go backwards down the supply chain. So, you know, getting much less towards the apparel manufacturers and then halving again at the fabric and fiber manufacturers. And in fact, while fabric and fiber are fairly similar in terms of revenue, this is likely in part because many of the fiber manufacturers are also making polymers for a bulk of other industries. So our aim in the programme really is to use this financial methodology and data with environmental data to fully understand the environmental impact of textiles companies through the whole supply chain. And really also then to gain depth amongst these nodes in terms of financial data through not just these nodes, but kind of sub-nodes to really understand the underlying industries. Now, fortunately, there is already some understanding of the environmental impact through the supply chain. This table comes from a Qantas study which covered the whole supply chain from fibre production through to textile disposal, although it's worth noting that the environmental impacts of microfibre production are not necessarily included in this. And you can really see quite clearly that wet processing is the most polluting stage of the supply chain, both in terms of climate change, human health, ecosystem quality, resource consumption, and slightly below raw material production in terms of freshwater withdrawal. And that's really why we've decided to focus on that wet processing part. You know, that's where there's a heavy environmental footprint, which could really represent a significant risk for investors exposed to that sector. And these water risks and these environmental risks are largely hidden from view when the fashion brands are considered. In most cases, the wet processing facilities are not necessarily directly owned by the brands and so often don't feature in the disclosures published by them. But it's really a part of the supply chain that does carry a huge amount of risk. So we've written so far a couple of reports to address these. So one report with Fashion Dye Another Day, we focused on water risk, linking factory location water risk data to the wet processes of company to the investors behind them. And in our briefing paper, Threadbare Data, we looked at how poor environmental disclosure in the textile wet processing companies are preventing investors from properly pricing ESG risks and opportunities. And I'm going to go through a little bit of the methodology behind those now. You know, we really found that wet processing is a significantly under-researched part of the supply chain, and this is in contrast to raw material production such as cotton, where a lot more work has been done on sustainability. Wet processing is highly dependent on fresh water, and therefore there are significant water-related financial risks. And if these materialize in textile wet processing jurisdictions, that means that water could become scarcer, with the potential to restrict supply to those wet processing companies. And that could result in the cost of water to businesses likely rising, putting pressure on the wet processing companies' operating margins. And they're already operating on pretty thin financial market margins. And so any losses could have real significant issues for the companies. And that then represents a risk for not only the active investors and passive investment portfolios, but also through direct investment and indirectly through investments from in any investors' downstream fashion brands. So our aim was really to look at the investments directly in wet processes, that least well-covered part of the supply chain. As mentioned earlier, companies operating these wet processing factories are mainly based in emerging markets, and therefore less well covered by financial researchers than perhaps the larger fashion brands and retailers, which are mainly focused in developed markets. The OAR gave this number of textile factories, so you can see in line with what I mentioned before that over a third of factories are actually located in China, followed by Bangladesh, India, Turkey and Vietnam, with only a few really in the developed markets. So our question really was, well, how can we link this factory location data to the companies behind them and then associate that with a water-based risk? The first step was really to find out the locations of the wet processes. To do this, we found specific location data for 1,600 factories, which we cross-referenced with 1,200 companies. And these factory locations are in 55 different countries. You can see shown here the types of countries that covered. The highest number of factory locations we found were in India with 407. And this is in part because when we were trying to cross-reference these with companies that we've identified as wet processing, we found 230 that were publicly listed, which allowed us to really link that factory data back to the investors behind them. Most of these are in India because we found that a lot of the companies in China were privately held, which limited the data we had on them. And then, so this 230 companies had a combined market cap of over $500 billion US, almost 600 billion, and really became the kind of planet tracker wet processing equity universe that we could do a fair amount of analysis on. The next part was to really understand the water-based risk associated with these companies. So we cross-referenced factory locations with the Water Resource Institute Aqueduct 3.0 water risk framework, which combines 13 water risk indicators, including quantity, quality, and reputational risk into a kind of composite overall water risk score, which we applied to our factory locations. And these scores did have a regional difference depending on the particular location in a different country. So you can see the levels in terms of low, low to medium, medium to high, high, and extremely high levels associated, which we gave a numerical number to in order to allow our analysis. So of the wet processing companies we identified, in fact, 75% were located in emerging markets as expected. And as we were looking further down the supply chain, we found that actually 80% of the companies we investigated were registered in the same country as their factories and didn't have any foreign operations, which also made this kind of application of water stress a bit easier. And so our conclusions were that it allowed us to calculate water risk scores for wet processing companies and then calculate the water risk to which the investors of those companies were exposed. And we found that 51 companies worth almost 30 billion have wet processing operations in regions ranked extremely high or high on the WRI's water risk scale, which does represent a significant risk to investors. Now, most of the investors were individuals, but also there are large asset managers like Vanguard and Wellington all exposed, as well as other banks and financial conglomerates. And while most or many of these investments are through kind of passive index funds, Capital in particular had more than $10 billion US in total allocated to wet processing companies in active funds. The next stage was really to understand then how this Planet Tracker wet processing universe of 230 companies reported their environmental disclosure. And this was not just water-based, but also across energy and chemicals management. So we defined 37 metrics, 19 quantitative and 18 qualitative around emissions, water and chemicals management and use. and collected data for each of these companies across these 37 metrics, more than 8,500 data points. We then use this disclosure to calculate an environmental disclosure score out of 10 for each of these 230 companies. And it's worth noting that here we're looking at publicly available information. So what do these companies publicly disclose? And our findings were pretty bleak. 10% of companies disclosed no environmental policies or data at all. More than 70% of companies had a disclosure score of less than 2 out of 10, while only 7 companies had a disclosure score of over 5. The maximum disclosure score was 7 out of 10, and that was for LVMH, which is a well-capitalized and publicly traded large fashion and lifestyle conglomerate. We came away with the following key findings all around environmental disclosure. First, only a minority of companies disclose environmental policies, and most of them just don't disclose the data required to enable investors to assess their performance properly. For example, many of the companies we know are exposed to water risk just don't publicly disclose what they're doing to mitigate that risk. Second, even disclosure around more mature metrics like greenhouse gas emissions is inconsistently reported and pretty challenging to extract from company literature, which really does again indicate it's hard for financial analysts and investors to understand and access the environmental risk embedded. And third, our analysis shows that the companies operating facilities in those high water risk areas as identified often provide the poorest environmental disclosure, which really compounds risk for investors. So not only are investors exposed to a higher water-based risk, but companies are simply not disclosing or acknowledging how they plan to mitigate that risk. So based on the limited data we're able to collect, we also did calculate that larger entities by revenue generally have a slightly better environmental disclosure metrics than smaller ones, which may well be expected. And so many of the companies in the universe are, of course, suppliers to many of the larger textiles, clothing and apparel brands. So while we are starting to see a lot more increasing investor pressure on brands, we do believe investors need to also focus on the wet processing suppliers. Poor environmental disclosures significantly impair the ability of the investors to assess those wet processing companies against their own ESG investing principles, but also against kind of ongoing business risk. And if wet processors are failing to disclose environmental data because they're not collecting it, then they also risk losing businesses from brands that are stepping up their requirement for environmental data from their suppliers. In addition, mismanagement can result in fines or even production closures, leading to increasing financial risk, such as from lower cash flows. Our analysis of the investor holdings show that of this 230 equity universe, show that family offices and individual entrepreneurs are particularly exposed, since on average they hold companies with much poorer disclosure scores. So what are the kind of call to actions that we expect in terms of investors from the work we've done so far? I think the first one really is that water related financial risk is real. Investors are exposed to this risk associated with the textile supply chain, both through their direct investment in suppliers, but also indirectly through their investments and financial support of brands. In many cases, brands and retailers depend upon the financial markets, their equity and debt funding, and indeed upon any financial institution in turn to access those financial markets. So really managing this risk is vital. The second is that there's really a clear need for investors and governments and regulators to act together to require a unified and consistent standardized global framework for reporting of environmental data. We really welcome efforts by the IFRS Foundation, the CDP, CDSB, GRI, IIRC and SASB to work together to really create a global sustainability reporting framework. And really, I think there is an opportunity for wet processors here to get ahead of this environmental reporting measures now and gain market share by adopting more sustainable approaches. And there's an opportunity for investors to pressure for that action in order to allow them to assess their progress properly. And then finally, we really urge the requesters request companies to radically improve their own environmental transparency and financial efficiencies, with other potential measures including a better disclosure of what strategic steps they're taking or have taken to mitigate environmental related risks, active management of chemicals risk, either through joining things like the ZDHC or adhering to REACH requirements, as well as a kind of consistent, timely reporting of comparable metrics around water, chemicals and energy use, for example, on a per kilo of production basis. And there's a clear opportunity for equity and debt investors to incentivize fashion brands and end retailers to take the actions we've outlined in line with their own ESG policies. But also there's this question that should brands help their suppliers transition, and should investors be pressurizing brands to mitigate their supply risks through financial incentives? You know, the picture is pretty mixed as to whether wet processing companies can actually afford to support potential transition costs without the help of the brands. If we compare just the EBIT margins across the wet processing, the average shows is almost 200 percentage points lower than the brand average, and much more for the larger brands. Wet processing companies, in fact, in Bangladesh have a higher EBIT margins ahead of the peer group average, suggesting that perhaps the Bangladeshi wet processing companies might be better placed on average than their peers to increase their debt levels to help fund the cost of transitioning. However, when profitability and cash flow strength are considered in total, it's clear that on average the wet processing companies are far less likely to be able to support potential transition costs than the fashion brands. Wet processors have lower margins, they have much more cash tied up in working capital, equivalent to 153 days of sales on average, than the brands, putting further strain on their finances, and they also have a much lower return on assets. So we see a couple of options. So either the funding for the wet processors could come from the retailers. A simplistic illustration, we estimate a 50 basis point cut in the average fashion brand EBIT margin from around 13.1% to 12.6% could provide 220 million of funding for the textile supply chain and increasing the EBIT of the wet processing companies by about 3%. However, this kind of direct funding comes with its own problems and is more complex. You know, how do you make sure that this payments actually do reach the wet processors, and how do you make sure that the money trickles down through the chain? But actually there are other opportunities for the financial community to fund this transition through other financial products like sustainability linked bonds from the brands, which could be used to improve the environmental impact of their suppliers, effectively the brand using their own investors to help fund the transition of their supply chain. And we're actually seeing some of these in action, with H&M recently announcing their sustainability linked bond. So what do we expect going forward should be top of investors' minds when it comes to the textile supply chain, and what are we really thinking about at Planet Tracker in terms of our next work? You know, ESG is clearly going to remain top of the agenda and going to make sustainability a continuing part of companies and brands' rhetoric. We see a few thematic areas. First, around natural capital risks and the financial risks associated continue to play an important role. You know, at the moment, there's not really one way that we think about natural capital or value it, but these conversations are going to continue to evolve as investor understanding improves. Related to this, we're going to expect increasing focus on measurement and proof of management of those environmental metrics. This is going to come through external financial reporting directives. So it's important that companies and investors remain agile in this space. Are they up to date with the data collection requests and inquiries? Can they be proactive and agile in the space to respond to the needs? And this is going to trickle down to companies as well, who are already starting to see an increase in the amount and frequency of data collection around their environmental metrics. And then finally, we're going to see we believe that there's going to be a huge increasing focus on full supply chain transparency and traceability. The idea that brands can't give full traceability or transparency is starting to be replaced with won't give it. Brands at the moment do think by not knowing they can claim they're not responsible, but we're starting to see that not being accepted, not only by the investor community, but consumers. You know, there's no excuse anymore. There's better technology around allowing full transparency and traceability through the supply chain, right down to that materials level. But there's not necessarily any single scheme or label yet that can ensure that. but we do think that's where it's going to go, and we're going to see a huge increase there. And that has a real potential to improve all aspects across the economic and social space, you know, allowing better work practices, and ultimately should also allow higher margins and better returns for investors. The good news is that we do think these movements will give suppliers with good sustainability practice much more power as well. So we encourage investors and companies to remain proactive and agile in the space. Thank you so much for listening. I'm happy to take some questions as they come up. So I have one question from David, and it's: the wet processing data includes the garment finishing after garments are done, like garment dyeing and jeans finishing. Not in our analysis. I think a lot of these places are fairly vertically integrated, but in terms of our node system, we think about them as two separate areas. So essentially a garment manufacturer would get the fabric and then make the apparel. So the garment production would be slightly differently. And then I have a question, another question as well from John. How far the supply chain should the brands examine? You know, my belief is that there is definitely full transparency required, and the tools are now there in terms of traceability. You know, this is not just kind of the infamous blockchain, but through genomics as well. And I think ultimately that will just allow us to fully understand the whole supply chain and where things are going. And especially, I think, as we come to kind of the post-consumer aspect, that, you know, the idea of where these products end up, if we know where they started and where they end up, you can kind of associate a responsibility both in terms of the consumer, but the producers as well. And, you know, the waste is a whole big issue that is quite hard to tie back to the financial community. So I think that's why it's incredibly important that we do identify and use as many tools as we can. And I think there are benefits as well for the producers. You know, if I know there's a lot of issues, as in a lot of supply chains, about, you know, if you're using a particular material, is it actually the same material you think you're using or that you believed you bought? And it's the ability that if you're a producer of that material or you're a buyer, you want to know that what you're buying is the correct product. So there's definitely kind of help for everyone in that system where there's a lot more accountability and understanding. I have another question, a bit more about the tools available for brands and retailers to measure their exposure to these issues you've mentioned. So there's a few tools out there. So things like the Higg index, which is used as a self-reporting system, where you can report your water use, emissions use, chemicals use, as well as, I think, across a variety of metrics, not just the environmental, but the social side. But that's the more brands and retailers use. For investors, it's very difficult to access this information. And that's more what we're trying to understand. What is the accessibility for the investors to be able to access that information? Because, you know, the investors are the ones making the decisions based on where they're going to put their money and how they're going to invest in the system. And what I found is, coming at it from that kind of financial perspective, it's very hard to disaggregate the information and understand. And because a lot of it is self-reported, which I think you're always going to have an issue with, that kind of adds its own issues. So at the moment, we're definitely going through this phase of people being aware that we don't know the information around. We need to access as much of it as possible, but it can be quite difficult to get it as an investor community. Don't know if there are any more questions. Oh, yeah. In your opinion, does self-reporting work? Is it better than nothing? Yes, I do think it's better than nothing. I mean, I'm very of the opinion that any change in a system is along a spectrum, you know, and I do believe we're right at the beginning, really, in terms of environmental disclosure. And part of that system is taking steps along, and self-reporting is one of those steps. Is it the perfect answer? No, but is it better than nothing? Yes. And I just think it's important in all these companies, we see continual striving to do better and to assess better. And is it possible to access the detailed report of the analysis you presented? Yes, our reports are available on our website. If you would like any of the data, it's completely accessible. Please just email us and we'll let you have it. We want it all to be publicly available, so everything is available on our website. And I think that's everything. Thank you all for your time so much. I'm so sorry about the issues at the beginning, and it would be great if any questions, please feel free to email us and the team. We'd love to have a discussion. Thank you so much.